The bond market is collapsing, I tell you. Dude, when you've been in this business as long as I have, you can't. It's amazing to me, the financial prognosticators, how people actually pay attention to these freaking fools. All right, so remember a few years ago, we had the inverted yield curve, and the inverted yield curve essentially is a 10-year yield on the 10-year treasury subtracted by the yield on the 2-year treasury. And you could look at it any way you want. You could look at the federal funds rate, but generally speaking, it's the 10-year versus the 2-year. And the inverted yield, oh, that's nice. I was going up there. I like that. They're freaking building like crazy in my neck of the woods. So anyway, the inverted yield curve, what it says is that we had the 10-year treasury trading, the yield on the 10-year treasury was below the yield on the 2-year treasury. Of course, that always showed that doom was coming, incoming. And we did have a recession, but nothing anyone talks about because it wasn't that big of a lesson. And a recession, again, is 2 consecutive quarters of negative GDP growth. That's all there is to it. We actually had that, but it was a recession because no one lost their jobs. We still had low unemployment. Consumption was still going up, so no one really cared. But, they also wanted to hide the recession because Biden, you know what I'm saying? But we did have a recession. But it wasn't, we've had an inverted yield curve for a long time now. And the minimal recession we had didn't even come around to be considered a real recession. So it just didn't work, all right? Part in terms of what the fear mongers would say. So the inverted yield curve, definite sign of recession. The 10-year and 30-year treasury going up. A definite sign of bad things to happen. Wait, what? So now we have no longer an inverted yield curve, but a typical yield curve, right? That yield curve just means the lower rates on the shorter duration bonds. So if you're going to lock up 10 years of money, you should expect to get higher returns on locking up the money. That's a normal yield curve. I get a 5% yield on a 30-year bond. I get a 2% yield on a 2-year bond, essentially, something like that. Now, it's not even anywhere near that as a yield curve, but generally speaking, that's what a normal yield curve is. The longer out you go in maturity, the more interest that you get on your bonds because you're taking on more risk relative to inflation. All right, so now we have a more normal yield curve, but instead of freaking out about the inverted yield curve, we're freaking out because bonds are collapsing, supposedly. It's just so freaking stupid. So when the inverted yield curve, all right, again, that just means the longer term treasuries are yielding less than the shorter term treasuries is here. Panic at the disco. When a normal yield curve happens, that just means bonds, historically, the longer duration you hold bonds, the more interest you get. That means panic at the disco. It's like, dude, heads I win, tails you lose. It's fantastic to be a financial prognosticator. And the funny thing is the yield curve is actually quite flat relative to historical norms. And what I mean by that is historically, you get a 2-year treasury at 2 and a 5-year treasury at 4. You know what I'm saying? Or a 10-year treasury at 4. Now it's a 2-year treasury at 2, a 10-year treasury at 3. Those aren't the right numbers. I'm just using that for an example. So it's flattened. It's not near. We're not even near a normal yield curve, and yet still people are freaking out. They just have to. It's like the media has to push something negative at all times. But it's always they push something negative when the Republicans is in office. That's what they do. Oh, people don't want our U.S. bonds. Oh, is that true? Then why'd they go down yesterday? All right, the bond market, the yields went down, which means the prices went up, which means there's a higher demand for bonds than a sell because the prices went up. More people are buying U.S. bonds and selling, which means the price went up. It's just basic supply and demand. Anyway, on top of that, we look at the 52-week track record of a 7-year bond, essentially. I don't know what it is for 10, but I'm sure it's roughly the same thing. The bond market is up about 6%, which includes the 1.9% decline we had over the recent times. 1.9%. And like this guy posted on LinkedIn, or not LinkedIn, on X, he goes, it's the horrible 1.9% drawdown. Oh my goodness, Katie, bar the door. Where's that from, Katie, bar the door? I don't even know. I say that. Lock up your women and children. I'm not sure where all that stuff is from. Anyway, they just can't help themselves, man. The bond market is not collapsing. It's stupid. Remember a few years back, the repo market is going to crush everything. I didn't even know what the repo market was. So when I first heard this, I had never heard this before in my life. Well, that doesn't mean it doesn't exist or it can't happen. I just said I've never heard anyone talk about the repo market. All of a sudden, this is like 5-6 years ago or something like that. Everyone's freaking out about the repo market. When I heard it, I said, well, cars are being repossessed. That's literally my first thing, because I used to be in banking. I used to lend money to car borrowers, and repossessions was always big on our list. Are we going to get paid, or we got to repo that thing? So repo for me meant cars being repossessed by the bank. And I was like, oh man, a lot of bankers, that scared me. I was like, well, if people are losing their cars in repossession, that's got to be indicative of something bad, right? No, it wasn't. Now, with that said, just because I haven't heard it doesn't mean it can't exist. I never heard of mark-to-market accounting, ever. I bet most of you guys never did either until 2008 came around, and then I was quickly made aware of what mark-to-market accounting was and how devastating it could be. So just because I haven't heard of it doesn't mean it can't hurt you. But just like the repo market, just all of a sudden out of nowhere, everyone's talking about the repo market. It's like, what? Then they talk about the inverted yield curve. Then they talk about the treasuries are losing, the long-term treasuries are going up in yields because the prices are dropping. I say, well, they're still quite low. 30-year treasury is still at 5%, amigos. That's and I don't even think it's that right now. I think it's less than 5 right now. That ain't bad, dude. 30-year treasury at less than 5%. That's where we need to be, 100%. That's a good equal rate for borrowers and savers. I think we're right there where we should be. All right, God bless. Love your thoughts. We'll see you.